Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Tom, welcome back to the show.
Owen, great to be back on with you.
It's always good, mate. New office, but equally good view as we record here in Sydney. We're going to talk about passive income. We're going to use ETFs as the vehicle to explain that, given that's your bread and butter. And we're going to talk about the power of passive income. So we'll define what that means, how to get it, how I think about it, how you think about it. And then we'll talk about some of the tools that people can use to build that out for themselves. So I thought maybe for folks that are brand new, so this is like a real quick question, Tom. If someone is totally new to this podcast and they're thinking, wow, this passive income thing sounds pretty good. When we use the phrase ETF, real quick as you like, what does that mean? What are we talking about? What is an ETF?
Yeah, so an ETF stands for Exchange Traded Fund. Very simply, it is a vehicle to invest through, right? So people might be familiar with shares or managed funds. These are different, ways you can invest. An ETF is just another way you can invest. The great thing about an ETF is it trades on the exchange, as the name implies. So it's really easy for investors to buy an ETF, just like they buy stocks. But an exchange traded fund, this vehicle can buy and hold lots of different liquid assets. It can hold, 100 different stocks in one ETF. It can hold stocks and bonds. It can hold REITs. So it's just a really great and simple way for investors to access liquid investments.
Yeah, so straight up, you can buy a basket effectively of different things, which we'll talk about some different things that you can buy today, because what you'll discover as you go through this podcast, I hope, is that you can get passive income from literally anything these days. And an ETF is like a big part of that scope for people. Like if you're looking to get income from property, but you don't have enough money to buy an individual house, or if you want income from shares, but you don't know which stocks you want to buy, you can buy an ETF. Or if you want to put money in a bank account, but you want a little bit more than a traditional bank account. Those are all available via ETFs and more. So we'll discuss that. I'm going to give a quick explainer of yield, which is, we're going to use this phrase a lot, which is yield. So when we talk about this, what we mean is that it's typically expressed as a percentage. It's kind of like if we say 5% yield, it means if you invested $100 for a year, you would get $5 back in income. That's the yield, right? But you're going to use that, I know, throughout this show. You're going to talk about the different ETFs. And even as we go across different asset classes or investment types, we're going to use that phrase. So you could compare property yield to a share yield to whatever you want to do. That's a bit like I'm butchering the term a bit there, but you'll get the idea as we go through. Maybe I'll start with a question to you, good sir. When you think about passive income, how would you describe what it is?
Yeah, so with passive income, it's a stream of money coming to us for us not having to really do any additional work for it. Obviously, you probably need some initial capital to get passive income. So you've worked for that initial capital, but then as you said, you can put that in a bank account. You can buy some bonds with that. You can buy some shares that pay dividends, and you can leave those alone over time, and they'll keep giving you income over time. And that's why it's passive income, and really great and really, really important for financial freedom. You earn your money, then you need your money to work for you. And passive income is a really big concept around that, making your money work for you.
And if people are at home thinking that they don't have any passive income, there's this big, not to bring TikTok into the equation too early, Tom, but there's this big theme that the team keeps telling me about. Like, there's this theme on TikTok, which is, do you feel broke? Do you feel poor? And there's this thing that's going around at the moment. But a lot of people that have superannuation, their employers contributing for them, that's the ultimate, in Australia, type of passive income that's eventually going to come back to you. So right now you can't access it, but when you hit retirement, it's going to be paying you an income stream and you're not going to be working because you'll be retired. So that's the ultimate form of passive income for most people. But a lot of people do want to retire early, which you mentioned, financial freedom. There's the FIRE movement, people wanting to retire early. Really, really interesting study was done many years ago Tom. It wasn't at all related to passive income, but a lot of people have taken it in this way. Is the IRS, which is the US's version of the ATO. They wanted to study the incomes of their wealthiest citizens in America. And what they found at the time was the average millionaire had around about 7 sources of income. Whereas most of us here in Australia, we think we've got our job. That's basically it. Then you go on to become an investor. You might buy some ETFs or some shares. Maybe you buy a property. It pays, rent. But most of the time in Australia, they're negatively geared, meaning that the rent income isn't enough to cover the interest bill, which is a whole thing in itself. We don't need to go into. But in Australia, the predominant source of passive income comes from dividend-paying shares, and you get franking credits, all those tax credits that come with it. One of the things that's been popularized in our industry being financed, Tom, over the years is this idea of the 4% rule. Can you maybe just explain what that is for people that are unfamiliar?
Yeah, of course. So the 4% rule, it comes from an old study that was done in the US. And essentially what they found over a 50-year historical data time period is if you were a retiree or you're about to retire and you took out 4% of your retirement capital. So you take out 4% that first year, and that's you look at the dollar figure. So say you've managed to save up $2.5 million by retirement, you get your super, you've got other investments, that would be $100,000. So that's the 4%. And then each year after that, for your retirement, in theory, based on this study, you can take that same amount, that same dollar amount, $100,000, and you should be able to, get through your retirement taken out for about 30 years. Actually, in the study, there was no individual starting date where the money didn't last for at least 33 years, right? So it's a pretty good concept. I mean, obviously, the caveat for investors is it's based on historical data. Future markets could be different, but I think the key principle that we want to take out of this is for a lot of people, taking 4% out of that, whatever their end sum is it doesn't sound too onerous. And I think the key thing is if over your time working and investing and putting money in your superannuation, you can build that nice nest egg. You can live off that really well via passive income and via the growth from that through your retirement fairly comfortably.
Yeah. Yeah, that's a good point. I didn't know that was the study over that long of a period of time. That's kind of cool. And I think that's like a rule of thumb people use. And in Australia, we're very blessed that we have things like the pension system. So if you don't have the big balance when you hit retirement, there is like a safety net that eventually kicks in. But for the bulk of your years, you're going to be relying on passive income from an investment portfolio. And I see this is more for our financial independence community members, but also for our retiree community members that are listening. That time leading up to retirement, whether it's early or what we classify as on time, 60, 65, what have you, there's like a 3-year window before where they're really panicked about having enough money. And then there's a 3-year window after where they're really involved in their investments. Absent that period, a lot of the time people aren't really bothered and they just go for simplicity, or they let a financial advisor deal with it, or they just go into like a managed portfolio or something like that. But that's a really good concept for people. If you're stuck and you're watching this or you're listening to this and you're thinking, well, what is safe for me to assume? Let's say Tom used 2.5 million. Let's say if you did $1 million, that's 40,000. I'll ask you a question in just a moment about trying to kind of like dial up that 4%. So what happens if we go to 7%? What if we go to 1%? Like what are the consequences of that? But I just want to quickly summarize some of the sources of passive income, which you defined rightly as not active. So it's everything that's not active. You're not actively working for it. Number one is interest from the bank, which most people are familiar with. ETFs, I'm going to ask you a question about this. They pay something called a distribution. Shares pay dividends. So we'll cover those in just a sec. We've got bonds, which pay coupon, or sometimes it's expressed as like a yield figure. It's like a percentage figure, like a bond portfolio. And then there's real estate, which pays rental income. Those are 5 or 6 of the most common types of passive income. So the question for you, for people that haven't experienced this yet, or people that just know that they get this, but they don't know why it's called this, why, when it comes to an ETF, do we call it a distribution and not a dividend?
Yeah, really good question. So if you think back to the start of the episode, and we said an ETF is that vehicle that can hold things like bonds or stocks within it. Companies pay dividends. Bonds pay coupons. Bank accounts pay interest. All those things can flow into the ETF. And so the ETF is just what it pays out is a more generic term of distribution, because it's not actually a company's dividends paying out. It could be one of these many sources of income, right?
That makes sense.
Yeah.
Yeah. So one of the areas that I see people go really wrong with searching for income for their retirement, or just even now while they're starting to build their portfolio, they've got $50,000 they've saved up, which is great, or $100,000, they're on their way, these types of things, is people often chase the thing with the highest yield. And I also see this with ETFs, right? They go for the thing that's like, well, why have 4%, Tom, when I could have 10%, right? So I guess, is that a mistake? Why is it a mistake? Tell me a bit more.
Yeah, we have to be careful when we're chasing yield. I mean, there's actually a few parts to this answer. We'll start with equities. We'll start with simple equities. When a company pays out a dividend, that's coming out of the value or the profits of the company, right? So there's this thing called a dividend trap, where you can see a company with a really high dividend yield. And if you looked at that alone, and that's what you're looking for, you might go, great, I want to buy that company because it's got a 30% dividend yield. That's awesome. Problem is, we have to think about, why did that company have such a big dividend yield, number one, and is that sustainable? Because a lot of the time, if a company's paying out such a high dividend, that means that the value is coming out of the company, number one. So the price has probably gone lower. That's why the yield might be so high. And it might be that the company has nowhere to reinvest its profits. It might be that it had poor profits but wants to excite investors. So we have to be careful looking at yield alone for companies. Definitely, number one. Number two, if we think about the fixed income space and bonds, typically the yield or the coupons you get on a bond are higher the riskier the bond are, right? So if the cash rate's around 4%, if government bond yields are giving you around 5%, and there's a corporate bond offering you, or a private credit fund offering you 20 or 30% as an extreme example, it probably indicates a much higher level of risk you're taking on within that fixed income asset, right? So does it mean you can't invest in it for part of your portfolio? No. Does it mean every company that pays a high dividend is a trap? No. But it does mean we have to do a bit more due diligence than looking at that yield figure alone.
Yeah, because it's not as simple as a bank account that's government guaranteed or something like that, right? I often think about it from a shares perspective, or equities, as you said. Like from a shares perspective, if I look at the long-term return of the stock market, let's say for round figures, it's 10%. If someone's going and they found an investment that's got a 10% yield, I immediately think to myself, is that because you're getting all income and no growth? And so people should be aware of this concept called a total return, which is income plus growth. Now, obviously, we don't know what the growth is into the future with like scientific precision, but we have a general gist of like why that company might be paying dividends, why it might be growing in the way it's growing. A good example is like BHP that sells iron ore to China and throughout the world. That's been able to pay a dividend, but also keep reinvesting in new mines and things, because it has to, otherwise it will just run out of iron ore. It has to keep building the mine, otherwise there's no more iron ore to dig up. So that's a really good illustration. My other question around passive income and just building that with ETFs, or just generally, is why do we need to diversify? So imagine in your mind, you've got someone that's listening to this that, is maybe, they've got a portfolio, it's kind of like a smattering of things, and they're not really structured in that. Why do they need to think carefully about diversification in your mind?
Oh yeah, diversification is so important for any discussion about investing, not even just income. Different asset classes, different investments will perform well and poorly under different market environments. The market environments under which stocks perform well, bonds perform well, real estate performs well, can all differ greatly. So if you put all your eggs in one basket, in the stock basket, and there was a stock market crash, that's going to really erode your capital. And if your capital's lower, even if the yield's high, if your capital's lower, you're going to be getting less income for the same yield percentage, right? Another thing to think about in this space is sometimes when we think about income specifically, is the things that can make one asset class's incomes higher can make another asset class's lower in a way. So what I'm trying to say here is, with stocks and bonds, for instance, we know that, typically if there is a growth scare in the market, we typically see stocks sell off, so that capital will come down. And that can be brought on by, at the moment we've got higher interest rates within the market, and those higher interest rates mean you're actually getting higher amounts of income for your fixed income part of your portfolio. And these things can kind of go in opposite cycles. So I guess it's very important to have good investments across different asset classes, have different streams of income, so not impacted at the same time.
Yeah. And that's actually interesting that you say that. So we're actually looking at some commercial property, like a new office in Melbourne. And one of the things that people aren't familiar with is when you go into it's not like a residential, like a home or something, like when you get a rental contract, there's built-in mechanisms to increase the rate of interest, the rate of rent that you pay for your office. And so, for example, it's usually a fixed amount, like a dollar amount plus inflation. So every year it goes up at inflation. And that's like a protection mechanism for the landlord, whoever owns that office or whatever, right? Now, if you think about that, if inflation goes down, they're not going to get as much income, but they're also kind of protected. But if you've got shares, imagine that landlord has the office that they're renting to me, and then they've also got their shares or something else going on. Inflation can be good or bad depending on what you've got. If you've got the office or you've got the shares or a little bit of both. And I think that there's many instances where having a bit of everything is really important, but particularly when it comes to relying on passive income. Like imagine an individual investor who has a lot in one particular share and their whole retirement is baked on that. I know people that are like that, Tom. They've got CSL shares, CBA shares, BHP shares from 30 years ago. They've done really well, admittedly. But now every waking day, they're checking the finance news to see, is BHP doing well today? Is CommBank, winning market share over Westpac or whatever the case may be?
Wouldn't be good for your stress levels as well.
Oh, yeah.
Diversify to lower your stress.
Absolutely. Yeah, absolutely. And that, again, like it could just be, you can keep your CBA shares, but maybe just add some ETFs alongside it, So I'm going to ask you about 4 different ETFs, and we'll spend a couple minutes on each. Now, I've got sent this list in advance, so I'm privy to this. We're going to talk about the QOZ. I'm going to use ticker symbols for people that are playing along at home. You can look these up. QOZ, YMAX or YMAX, MMKT, which Hugh, your colleague said, cash ain't trash, by the way. That was his headline for that one. OZBD. So we're going to talk about all these in order. These are the ticker symbols. If they don't make sense, Tom's going to clear that up for us. First of all, let's start with QOZ. What is this ETF? How does it play a role in passive income?
Yes, this is the name is the BetaShares FTSE RAFI Australia 200 ETF, right? So we already know the Australian market historically has had a pretty good dividend yield, particularly compared to international markets. Some of those big financial companies, big resource companies we have tend to pay high dividends. So you can get that from a typical Australia 200 ETF. QOZ just takes it a little bit further. So we know with the broader market, like your Australia 200, we pick the companies based on size alone.
Yep.
Bigger the company is, more weight it gets. Really simple. What QOZ does, it takes a very similar 200 companies to the Australia 200 or the ASX 200. It just weights them a little bit differently. It weights them based on underlying fundamentals. So it weights them based on their sales, based on their cash flows, their book values, and finally, their dividend yield. So we're putting a bit of emphasis on the dividend yield this company pays to give it a bit more weight. And so it's kind of neat in and of itself. It's a smart beta way, if you will. So a different way to size to weight an index portfolio for investors not familiar with that term. And what this has meant is, on the yield side of things, it's had about a 1% higher dividend yield compared to the broader Australian market throughout its 10-year history, as well as outperforming the broader market. So for investors particularly investors who are concerned about how big some companies can be in their portfolio and not liking that size alone is a determinant, this is a really cool alternate way to weight a broad market portfolio. Still is a broad market portfolio, so you're still getting all those companies, but a nice yield pickup along with this fundamentally weighted portfolio.
Yeah, I can see here. This is just the time this is as at 31 January 2025, I should say. So you can go to the BetaShares website and check this out. In terms of the 12-month distribution yield, so historical, keep that in mind, 4.4%. If you include the franking credit benefits, 5.6%. So you can see here that we're kind of juicing that up a little bit because the actual overall stock market, like A200, that would be sub 4%?
It's about 3.5%.
Which is pretty low by historical standards, isn't it?
Very low, very low. That's like the lowest it's been since the GFC.
Oh, wow.
Lowest it's been. So typically you'd expect the ASX 100 to be that 4.5, 5.5, which QOZ is, but the market's a lot lower at the moment. Yeah.
Yeah, interesting. Okay. So that would make sense then. So you still get a lot of the names that you're familiar with, ANZ, BHP, Woodside, Woolworths, all these names that people will be familiar with in the news. You said the good thing about it that you said is like a lot of people that target passive income, as we know, they go all for income and get, when I say no growth, they get negative growth. I hate that phrase, but negative growth, which is actually a loss. So they kind of get the income, but take the loss on that side. So it's like at the end of the day, what are you actually getting? Whereas this is done well in total return terms. So the growth plus the income.
Correct.
And you still get franking credits, which is going to appease our retirement listeners. The next one is I would say like a step up in people's understanding of how to invest for income. This is proven to be very popular over the past 12 months in our community, which is YMAX, YMAX. Let's start with the name and then we'll break down what it does.
Yeah, so it's a yield maximizer fund. We've got actually a suite of these funds, but I'll focus on the Australian one, but I will mention the other two we have for investors looking beyond Australian equities as well. But this fund uses something called a covered call strategy, which some investors might be familiar with, some might not be. Essentially, this comes back to our whole discussion, right? When we're looking at sources of income, it's great to diversify those sources of income. YMAX holds the top 20 companies in Australia, right? So those names,
BHP,
you just rattled off, right?
Combank, yep.
So you're getting the dividends from those companies. That's your first source of income. The second source of income within this fund comes from selling call options. Mm-hmm. Okay, so when you sell a call option and someone buys it off you, they pay you a premium. They pay you some income. Great. So that's giving us a bit more income to add alongside the dividends we're getting. We've diversified our source of income there. Very important to explain what that means though to investors. So when you sell a call option, you are selling away some of the potential future upside. So you'll say, hey, I've got this stock at this price. I'll sell you a call option at $5 higher, right? Person goes, cool, I'll buy that off you. Here's some money. If the stock rises to that $5 higher mark, you're going to get that upside. But beyond that, the person who bought the call option off you can say, hey, wait a minute, I can buy that stock off you for that, what it was, plus $5. And so you forego anything above that. You know, there's no free lunch in investing. What's good about YMAX's strategy is we do write those calls. The term is out of the money, i.e. we write them with that buffer. You know, we say we write them a little bit dollar higher value because we want to participate in the upside. As you said, we want some capital upside. If the market absolutely rips, if the Aussie market goes on an absolute tear, you're probably going to lose some upside. But if it goes, if it's trending slowly higher, sideways or downwards, you're going to get that income and you're not going to have to worry about forgoing the upside. So a great way to add a diversified stream of income and just additional returns in markets that aren't, going very strong.
And this is, I would say it's probably in some ways quite a contentious ETF for that reason, because in some ways people worry about, well, if the market does go way higher, how much of that am I giving up? But I think that's maybe not the right way for investors to look at it. And the reason I say that, Tom, is that so over the last 12 months, this is until 31 January 2025 as well, not to date it too much, it's 11%, which from my memory would probably be similar to the broader market. Mm-hmm. But the difference is, and this is how I tend to think about this, the difference is that you're getting income, and that income comes with franking credits as well. So for people that may be more retirement focused or thinking, well, I want the kind of exposure to Australian shares, like I know long term I want some of that, but I also want to kind of just dial up the income a little bit in a different way. This is where I think this strategy does most of the heavy lifting for people. Mm-hmm. And I can see the 12-month distribution yield here is 7.5%. So definitely on the higher end, right? Pays income quarterly. Probably should have covered that at the top of the show. ETFs tend to have a set cadence, which is quarterly or half yearly typically. Some do annually, but those two, at least in the beta shares range, quarterly and half yearly.
Yeah, particularly if it's an equity income fund. So funds that are focused on income, we know that investors are buying for that purpose. It'll typically be quarterly, if not monthly for some funds like fixed income.
Yep. Yeah, which we'll get to in a minute. But yeah, so effectively this is like a way to blend it into the portfolio. And I'm glad you did lead with the risk, because that's probably one of the things that people should be aware of. But in what we see is those kind of markets where it's not, it's unpredictable, stock market anyway, at the best of times from one month to the next. But for markets where they are kind of just rallying higher, this one can still provide the income benefit, and it can be blended with another ETF. That's probably the key phrase there. It's like it's blended in to the mix. Okay, so those two shares, right?
I should quickly touch on just as I mentioned at the start of that section, we also do have
US the others,
just very briefly.
Yeah, go for it. Yeah.
Investors who are interested. So that's in the Australian market. We've got the same thing on the S&P 500, same thing on the NASDAQ 100, which is UMAX and QMAX. So those are lower yielding markets in general, but higher volatility, which means you typically get more money for those option premiums. And so because both the QOZ and YMAX were Oz equity examples, there are examples outside of Australia. So I just wanted to just flag that for the audience.
Yeah, absolutely. No, that's a good point. And like you said, because a lot of people investing in the US don't invest for income, but there's a way to kind of artificially kind of create some more income for yourself.
Exactly right. And even like the QMAX ETFs on the NASDAQ 100, it actually kept up with the NASDAQ 100 last year despite how well it went.
Oh, so really? Did
it only returned about 1% lower than the NASDAQ in the end. A lot more from income. Why? Because sometimes it's just the timing of when you sell the call options and also the extra income you get from the volatility. So it doesn't necessarily mean you'll always underperform in those.
Yeah, because this is interesting, Tom, because a lot of people, like, even the way I think about it is if you look at, like, say the S&P 500, which is like the 500 biggest US companies, it yields like 1 to 1.5%.
Yeah.
You don't really buy US stocks for any type of income. But a lot of people know that they want a big chunk of US stocks in their portfolio, even in retirement, because they're like, well, maybe it grows faster than anything else.
Exactly.
So the ability to have some income, if it's like 30% of someone's portfolio, like those overseas stocks, they still want some income to keep them company. So that makes a lot of sense. So thanks for bringing that up. MMKT is the ticker symbol of the next fund/ETF that we're talking about. Our audience is extremely familiar with AAA. It's probably one of the best ticker symbols, AAA being the Australian cash ETF from BetaShares. But MMKT takes it a step further. How do you describe this to someone that maybe is not 100% across like what we're about to talk about, money market securities and these types of things? Like, how do you break this down for us?
Yeah, I think the simplest way to explain it is, you or me, Owen, if we went to put our money in cash outside of the ETF and investing landscape, we'd probably go to a bank account and put that money in a bank account and get interest. And that's AAA. If you or me were a big institution, a big super fund, a big sovereign wealth fund, and we were going to put cash in, the bank, we'd actually not put it in the bank, we put it in money market securities. And these are just short-dated loans, banks between governments, etc. It's essentially like this is where big institutions will actually park their cash rather than a bank account.
Right.
The securities we're talking about are very short-dated. They're typically floating rate, so they're very capital stable and typically very safe. But the neat thing is you just get a nice little pickup on cash. So for MMKT, you're looking about a 20 to 30 basis point pickup on AAA. So nothing mind-blowing. We're not in that, talking that 7% range. But if you're investing in a cash allocation, why not get the most you can out of it? And this is a great access ETF because previously, investors like ourselves would have no access to these securities. You need huge sums of money to invest in them. It's a sophisticated market. But the beauty of ETFs is that access angle. Our portfolio management team handles that side. Investors can go on the ASX and with a simple trade, buy institutional grade cash products for their own portfolio at home.
Yeah, right. So you can, if you've got that money in cash anyway, you pay a little bit of fee for the ETF itself, but then you get a higher uplift on the income. Yeah. Okay. Now that makes a lot of sense. Now this next one is kind of a step again, which is OZBD. I would say this one's actually probably more easy for people to understand in some senses because we've talked a lot about bonds. A lot of people who are on the younger side of our audience, Tom, they'll say things like, oh, do I need bonds? I think bonds are still respectable, and particularly now because we can get income, which we'll talk about. Whereas 5 years ago, it was a different story. And for retirees, it's kind of that sleep at night factor where if shares fall, you've still got your bonds, which hold up in theory. You can take some of that, then invest in the cheaper stocks and then participate more in the rebalance and the kind of not rebalance, the rebound that comes. So OZBD is the ticker symbol. What is it and what does it do?
Yeah, so it's just simply, it's like a composite bond fund at BetaShares. So it invests across Australian government and Australian corporate bonds. So that's simple, right, for investors. But as you said, particular types of investors, particularly those older retiree investors who've already built up a really nice big capital base, and are maybe less comfortable with the volatility of the stock market, or want to add in those diversification benefits, because it's much riskier as you get older if you lose a big sum of your money to be taking money out for retirement. So this is a really, really simple way for an investor to access a diversified portfolio of bonds, and it kind of takes the complexity out of it. Investors who aren't as sophisticated in bonds, who say, should I buy government bonds? Should I buy corporate bonds? Or what's the right mix? This ETF just does all that for you, and you get a nice blend of those. You get some good income from the corporate bonds, particularly of higher income, and the government bonds income, as well as those pretty good defensive properties as well. So a really easy one-stop shop for investors.
And this is particularly telling at the time of recording. We're recording this mid-Feb. Interest rates broadly are expected to slowly come down in Australia. We don't know that for certain, but that's the likelihood, they say. And bonds actually benefit from that. So just for people who are aware, it kind of adjusts. It's not like a term deposit, which all you get is the next month's term deposit rate goes down. With bonds, you actually get the value of the bonds going up, in theory. Just looking on the website here, the 18th of Feb, 2025, running yield, which is what I tend to look at when I'm looking at bonds and the current expectations of income.
Mm-hmm. For an ETF, it's better to look at the yield to maturity.
Talk to us about that.
It's better to look at the yield to maturity. So as you know, the running yield is the current income a bond pays compared to its price.
Yep.
Within an ETF though, particularly beta shares ETFs, we will actually look to pay a smooth distribution. You can see that when you go to the web page and you go down to the distribution profile. We pay monthly distributions, and those are smooth. They're generally a similar amount, and we're actually targeting the yield to maturity.
That's right.
Because the yield to maturity takes into account the value of the bond when it is eventually sold, because bonds can be at premiums or discounts, and so it's the more accurate figure to look at for bond funds.
Interesting. So because it's effectively adjusting so a bond, for people who aren't familiar, is like an IOU. Mm-hmm. You lend money out and it's a promise to repay it with some income in between, right? So that's absolutely, I would look at that. Interestingly, you're right. Like, it's very smooth. Cents per share. You can see that on the website there. Monthly in income. Is that right?
Yeah, monthly. Yeah.
Yep. And so that at the time of recording is 4.87, mm-hmm. which is significant compared to what it was 5 years ago.
Yeah, and also in the current market environment, we talked about this, but on the ASX 200, the net dividend yield is currently predicted for the next 12 months to be 3.4%, and the gross yield around 4.5%. So at the moment, and this doesn't take into account the hopeful capital appreciation of the Australian market, but at the moment, that fund would be yielding higher than the Australian market, which we don't often see. To be honest, yeah. Normally it's the other way around, right? Like you'd have, like, shares are riskier than bonds in theory, right? So you would expect that the shares should be paying you more. With this, people will look at the historical returns of bonds, particularly bond ETFs like OZBD, and they'll go, oh, well, that looks terrible. That's because we've been through a period where the opposite has been true, where interest rates have gone up and the bonds have had very little income. So it's had to adjust. But now we're at a potentially, we should say, be clear about that, we're at a point in time where income is solid, very solid, and there's potential for interest rates to go down. So this is one of these education pieces for people, Tom, that if you've just invested in the standard index funds like A200 or something like that, and you're wanting to build a proper portfolio that is diversified, it's actually a great time to start building one of those. Yeah.
Because you've got things like MMKT, which you mentioned, or just cash ETFs in general. They're okay, and particularly for now, but as interest rates fall, expect the yield to come down on those. But bonds kind of have an embedded feature, which is that it benefits from that on the way down. Mm-hmm. And then you've got all different we haven't even spoken about different things like infrastructure and different types of investments that you can make through ETFs. But that's how you build a robust passive income portfolio. So this is OZBD. There's a lot of literature on the website. It goes through a bunch of different things, as well as how to study bond ETFs in general. Okay, so if we take these 4 ETFs, Tom, we've got QOZ, Australian shares, YMAX, which is Australian shares, but also with the kind of like the call option, the extra income source. We've got the cash plus ETF, which is MMKT, and then we've got composite bonds, like just bonds in general, OZBD, how can people think about where they'd slot into a portfolio?
Yeah, exactly right. So it's going to depend on the investor. Like some investors might want to build a complete income portfolio. I guess one thing to be cognizant of is not all income ETFs will be a full asset allocation building block. What I mean by that is like an Australia 200 ETF, right? That is kind of what you'd call a building block for Australian equities.
Yeah.
And that represents the whole Australian market. There's obviously different ways to do it, but that's a building block. But not all Australian equity income ETFs will represent the whole market. So important first bit of research when you're looking at an income fund in bonds or in equities is to understand what is this representing. Is this representing just Australian large caps? Is the bond fund just government bonds or is it corporate bonds? So that's important. And you can use them together as we kind of talked about. So you could use the Australia 200 fund and then some additional YMAX to add some income. Or, since YMAX already has those top 20 Australian stocks and nothing else, you could use YMAX for the top 20 in the income and then something like X20, which is an ETF that holds...
20.
Exactly right. It doesn't hold the top 20 companies. So then you're actually holding the top 200, but you're getting more income from your top 20. So these are ways you can, I guess, use asset allocation completion tools in a way to get total exposure of the Australian market with that income kicker. Same applies in the international equity space. We talked about those sister funds to YMAX that were UMAX and QMAX. With the S&P 500, you might already be holding that, or you might be holding the S&P 500 equal weight, and you might just drop that weight by 10% in your portfolio and put that 10% into the UMAX. So you still hold the broader one, you just got a portion of it now to cover core strategy on top. So for investors, still think about the different asset classes, that you're building, Oz equities, global equities, fixed income. Understand how much of that asset class these different equity income ETFs represent, and then, look for ways to complete the asset class if necessary with other ETFs or funds.
I think it's just getting a bit like for folks that are kind of the one and done, like they have one ETF that does that or one ETF that does this bit. That's what people want, is a little bit more flexibility. And, we say start with the end in mind in many respects in our lives. For investors who build like their portfolio in one way from the beginning, they have to be very careful that when their life changes, they need some flexibility. And so there are certain building blocks, like, because the problem is if you build and you dollar cost average into certain ETFs, you get to a point where you've got a significant amount in there and there may be tax implications if you try to change it in any way. And so that's why I'm kind of a fan of people DIYing, or at least following models, like following something, so that in the future, if you want to change one component or you want to swap out a little bit of it, you do have that extra layer of flexibility, which can really help people, because it's really only once you get to retirement where things can become quote unquote tax-free in certain environments. I've got maybe one general question for you, which is, if you think about like all of the BetaShares ETFs, how many did you say?
We're nearing 100. We're very close to 100. I think we're in the 90s, yeah.
Yeah, right. So if you think about it, so we spoke about the rule of like the 4% rule. Do you think with some of the things that we've spoken about today that it would be possible for someone watching this or listening to this to get more than that in the current market environment, like sustainably, not just kind of like hope and a prayer, but just legit get, say, 5% from a portfolio?
Purely yield?
Yeah.
Yield, yeah, you could definitely, particularly in the current environment. As you said, interest rates around that 4% mark, which is higher than recent history, but not high by a longer term standard at all. If you think about I think the RBA, their neutral rate, they still say is 2.5%, right? So can we beat the cash rate by 2.5% is essentially the question you're asking in a sustainable manner. I think, yes, you definitely can. You definitely can. A great example is the YMAX ETF. Like, as you said, it's had capital growth and 7.6% income over the past 12 months. Couple that with an ASX 200, which is giving you around 3.5%. So you meet in the middle there at about your 5%. And we know the ASX has grown roughly 10% over the 8 to 10% over the long term. So as your equity is fairly sustainably done. At the moment, you'd probably want to blend in some fixed income to have sustainably high just because it's offering more. You've got funds offering upwards of 6% for floating rate funds, which is a really, really strong yield to get.
Yeah.
And that 6% can probably help buoy our international equities, which are typically a little lower than the 5% mark.
Like the US shares and all that sort of stuff.
So I think it's definitely sustainable. And also just back to that 4% rule as well. So that 4% rule, the worst possible time frame, the worst possible year for markets using that 4% rule, still got the investor 33 years of retirement. So we don't know what's going to happen going forward. But a lot of people say that's conservative, right? If you took the medium or the middle, outlook for the market over that study, you could actually get upwards of 5 or 6% sustainably. That 4% is just saying, hey, this is the worst possible time to put your money in. You can still do the 4% thing, and you got 33 years out of it. Pretty good.
That's pretty good. So yeah, and that's really reassuring for people, I think, that are trying to put all their money together to build that passive income stream. I think that's really reassuring. One of the things I should mention is the reason why, so we're talking, like you're obviously an ETF guy. I'm from the better part an ETF guy, like love shares and everything really. Property too. I'm one of those. You own a property. But the reason why we haven't spoken about that much is one, you can invest in property through an ETF. It's just a different type of property. But secondly is typically residential property that people know is not a source of passive income because there's agent's fees, there's maintenance fees, there's interest if you've got a loan, there's a whole bunch of different fees. If you sell, there's a lot of costs involved. So there's a lot of stuff that goes on to that not being a superior use of for passive income. It's good in growth phases, don't get me wrong, especially here in Australia. But as people get closer to retirement time, I see a lot of people transition from property straight into ETFs and straight into shares for the franking credits, for the true positively geared portfolio, so to speak, a portfolio that generates reliable, consistent income through time. We're going to put a heap of links in the show notes here. We're going to list all of the ETFs that people can go and research, as well as some of the adjacent ones. So you mentioned like the other sister funds, but also A200. I mentioned AAA earlier on. So they'll all be in there. There's a lot of literature on the website for passive income seekers. You guys do a great job of education and just literature around that. I know you write a bit. So that'll all be in the show notes for people to go and check out. So have a look at that. Have a look at everything that's available on the website. Study those total returns. Study the income. And Tom, this has been heaps of fun. So thanks once again for joining me.
No, thanks. I really enjoyed the discussion.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.